This is Daniela Cambone for StansberryInvestor.com, and welcome to our summer series here. My guest today is Simon Dixon, founder of Bank to the Future. Simon, thanks for helping to kick off this series where I've asked some of our fan favorites to come back for a mid-year touch base. So good to see you.
Yeah, good to see you too. Delighted to be back.
Yeah, we have a lot of ground to cover today. You are one of the greatest Bitcoin experts out there. So my question to you is, look, a lot of proponents of the cryptocurrency argue that it shines during times of inflation. But that has not been the case thus far this month, Simon. Bitcoin is not acting as an inflation hedge against the rising prices. The coin has declined 10% so far this month. And year-to-date, advance has narrowed to just 6%, meaning the S&P is outpacing it by roughly 9 percentage points. So what's your take here?
Yeah, I mean, Bitcoin short-term is still a highly manipulated market. So it doesn't have the level of liquidity to short-term not have mass manipulation in the market. But that's the same with many financial markets. So if you're recording on a month-to-month basis, Bitcoin certainly isn't that short-term hedge. However, the play with Bitcoin is a long-term hedge. So that's really the way to think about Bitcoin. Short-term, you've got very, very wealthy people that own Bitcoin, that put them in and out of exchanges, manipulate prices, and try and extract as many Bitcoin from those that are trying to get rich quickly.
So to that point, if it is a long-term play, I'd love for us to talk about Bitcoin in a retirement portfolio now, because a recent article and research from the Wall Street Journal found that more and more folks are curious or looking to add cryptocurrencies to their retirement portfolios. In fact, a recent survey of more than 500 financial advisors conducted by the Financial Planning Association found that 14% of advisors said they use or recommend cryptocurrency. That's compared to just 1% last year. So a huge jump here in interest in Bitcoin in a retirement portfolio.
Yeah, so at Bank to the Future, we launched our Retirement Plan B product, and we have never seen demand like it. The amount of demand for people to be able to hold Bitcoin and invest in this industry and sector has really, we've never seen anything like it out of all the products that we've launched. So I think there's an upside and a downside to holding Bitcoin in your retirement. So one of the big benefits of Bitcoin is giving you the ability to own your own money, spend your own money, and have the money supply that's completely fixed. But when you hold it in your retirement plan, you're most likely going to need to do that via some kind of custodian, in which case you introduce some of the challenges with a traditional financial player. The good thing about holding it with a custodian as opposed to a bank is that they have a legal and fiduciary duty not to rehypothecate and reuse, but you're still holding it with a third party. So that's one of the first things to think about with Bitcoin. The other things to think about is you could go as simple as you want just by putting some Bitcoin. You'd probably have to open a special IRA or something in the case of the US, or other countries have things like self-invested personal pensions and SIPs. Or you can just do it outside of a traditional retirement plan. The main benefits is that you get the tax deferral, so that if you have gains, many people are considering the tax situation of Bitcoin now. But also if you're doing other more exotic plays, so some people want to not just own Bitcoin, but they want to lend some of their Bitcoin and receive yield. That would normally be taxed as income. But if you do it within a retirement plan structure, you can defer and really benefit from a compounded income effect. And then if you're doing things like buying equity in some of the companies, then a retirement plan structure, it has real benefits in terms of deferrals and really accumulating the growth and holding it long term, which is where the real gains have been in Bitcoin.
Can you also talk a little bit, because I know you do a lot on your YouTube channel and your research in terms of taxation implications to think about in regards to Bitcoin and a longer term plan here?
Yeah, so many people are trying to figure out the tax situation. One is different in every country, but it's starting to reach consensus. Just around the time when Bitcoin reached above $200 trillion as the market, the entire market reached over $200 trillion, governments really stopped attacking Bitcoin and started seeing it as a tax collection opportunity. It wasn't really clear in the early days how to treat it as tax. So there's a lot of people that are trying to figure out how to handle the tax situation. So it's really a force against the whole won't governments just ban Bitcoin? Well, when there's a lot of money on the line for them, then they probably won't. So the way that Bitcoin is typically treated, I can't give tax advice. Obviously, you'd have to speak to your tax advisor. But every time you exchange Bitcoin for another cryptocurrency or a stable coin, or you put it into a DeFi contract, you normally create a taxable event for yourself. And most people don't consider the taxable events because the price of crypto is moving so fast. And if they're trading in and out, then they tend to not think about the tax till later. That's a big mistake. And one of the real benefits to not trading and just being a long-term investor, if you're lending out your Bitcoin, then you normally receive some kind of income. If you're selling, then it's normally treated as property and subject to a capital gains tax. And then when you start going more advanced, like doing things like leverage trading, the more complex you go with the product, the more complex the tax situation can be. So it's still the real advantage, again, is doing it in some kind of retirement plan and also making it as least complicated as possible. So you don't end up creating these multiple tax events and really start thinking about planning that.
Really good thoughts there, Simon. I have to bring up when we're thinking long-term plan, and I hear what you're saying, but a lot of folks out there are saying, how can I add it or think about adding it to my retirement plan with the volatility? We've seen the correction thus far this year. What do you say to those folks?
Yeah, again, Bitcoin is a 12-year bull market, the highest performing asset class in history and the highest performing investment in history. And in that, you get a lot of volatility. So if you're watching the day-to-day price, then you are going to feel fearful. And with Bitcoin, there's always a million reasons why it should fail. And so everyone's going to be telling you those reasons why it should fail. But really, when thinking about it, it's a binary bet. So you're not going to put your entire retirement plan into Bitcoin unless you're particularly inclined to think that way. But most people are putting a percentage. So the professional fund managers like the Paul Tudor Joneses, they started very conservative with 0.5%, and now they're pushing up to 5% of their portfolio. You have to think about it as a binary bet, really. Either the industry is going to completely fail. My belief and my investment philosophy is that it won't, and therefore it's not going to be worth much, or it's going to be worth many times more than it is today, because the investment thesis, if it becomes true, that Bitcoin creates money you can own, money you can spend, and money that has a fixed supply, is, from my perspective, worth a lot more than it is today. So you got to really cut out the noise and the day to day and think about where you think it's headed. And retirement plans are perfect for that because they penalize early withdrawals, and really it's thinking about it. So don't put your whole thing, is really the advice, but put a percentage of it and really think about it in terms of what goals you want out of it. It's the part of the high return, high risk part of the portfolio.
When you say don't put, you place all your bets on Bitcoin, I think that's very sound, because a lot of other Bitcoin proponents, will come out and say, I'm all in, or I'm 100% Bitcoin. So when you say don't place everything, how do you make that call in terms of percentage points? I understand you're not a financial advisor, but what are things to consider with how much you should be allocating?
Yeah, obviously, to give sound financial advice, I'd need to understand more about your individual situation, your liabilities, what your goals are, how long till you retire, and all the usual things a financial planner would go through with you. But really, it's the way that I think about my portfolio is that with my retirement plan, I have a percentage that's allocated towards getting exposure to the growth of Bitcoin and the wider crypto markets. I have a percentage that's allocated towards US dollar traditional denominated assets, and also a percentage that's allocated towards gold and various other factors. But it's portfolio theory. It's a modeling out a series of outcomes. If you believe in things like Ray Dalio's or Seasons portfolio, then they model out for inflation, deflation, economic growth, economic decline, and you try and allocate 25% towards each outcome, so that whatever happens in the world, you're comfortable. And the other way to think about it is that you might, traditional financial techniques that are used is think about things like in financial planning, they talk about your age, and using your age, taking it away from 100, that's how much you should allocate towards stocks and bonds. Well, think about it as a play like that. Maybe it's traditional markets versus crypto markets. And you can think about it. So it all really depends upon your appetite to risk, how much you need a conservative. The real challenging thing about today is what has traditionally been known as conservative has also become quite speculative. I would argue that one of the riskiest places to leave your money is at a bank right now, which most people have gone off for the mantra, cash is king. So it's a very complex environment to navigate, but there's a number of methodologies you could use, and we work with our clients to help them figure out exactly what's right for them with their goals.
Why do you say that the most dangerous place to leave your money right now is, in fact, the banks?
I believe that we've hit a really scary level of systemic risk in the banking system. I know ever since 2007, the banks have been trying to pass those stress tests, but really we've only worked on symptoms that were caused, and I still think all the underlying systemic risks in the financial system still exist, which is why gold and Bitcoin and investors, are waiting for such things to happen, as it were. But I still think that the risk in holding your money at a bank, where you're subject to the credit risk of what the bank is doing with your money, is still an unacceptable risk, which is why I hold the minimum amount possible in a bank. And I just expect that money at a bank is very hard to sell, very hard to use, sorry. You have to produce more and more documents in order to use your money. And the risks that the banks are taking in order to try and generate their models right now is also being propped up by governments that are looking to re-stimulate a real estate market and a property market. And banks are the main mechanism for creating digital currency, propped up by debt, and the levels of indebtedness have reached all-time highs to the point where only a central bank digital currency can bail out the system at this stage.
Okay, and we're going to get back to that point. But you mentioned the stress test. We saw the results of the US banks now. They passed the test. Do you not believe the test then?
I do believe the tests, but the challenge is what they're doing with those tests. So most of those toxic assets have been rehypothecated across to selling to your pension or selling to your hedge fund. So it's just the risk in general that if you think about things like FDIC insurance, it only covers less than 1% of the entire deposits it's meant to be insuring. So one credit card crisis, one student loan crisis, one real estate correction, a moment of deflation, an increase in interest rates can really knock the domino effect in place that has knock-on effects to your deposits, as we saw in the last time the dominoes were hit in 2007-8.
I want to get back to your point about the digital currency. So much talk surrounding this now. Why do you say it's the only thing that can save the system right now if we were to see a Fed coin or ECB coin?
Yeah, so from my perspective, we're at the end of a large debt cycle, and individuals are maxed out as far as they can go. Businesses are maxed out as far as they can go, particularly small businesses. Large businesses are leveraging the financial markets in order to access cheap credits to buy back their stocks, which is meaning that there's somewhat of a wealth effect in the stock market. And governments are maxed out. So really, it's all on central banks. The entire economy has moved to a central bank-led economy. It used to be that central banks would try and manipulate interest rates in order to control how much digital currency the banks create every time they issue a loan. But now it's really rendered ineffective. The only real way to do this is to over-leverage the economy. And then when the banks hit that systemic risk event, let the bank go bust and exchange it for currency that was created by a central bank. And this is where I think everything goes. It's the only card left, the trump card, as it were. But it's the only card left in order to rehypothecate the system without, trying to increase interest rates, except that we need a deflationary effect in order to unwind this rich-poor divide. You either take that route, or you take the second route, which is more control, less privacy. It meets their agenda and their goals in order to control every single facet of money. I expect, universal global taxes on all payments, as a counterforce to the fact that everybody's global now. The murkiness of borders are causing huge problems for governments. And so the only way to really reverse those effects and keep the model sustaining, let banks go bust, don't let people lose their money. Rather than a bail-in, just bail out with central bank digital currency, and then implement global taxes where you can control every mechanism and facet of fiat currency that's now created as a central bank, rather than this debt effect of having retail and commercial banks create the digital currency,
Wow.
which is the system we have now.
Let banks go bust. Simon, a lot of good stuff to unpack there. I want to get back to your point about, I want to bring back the point about the Fed digital currency and bring it back to Bitcoin, because opponents of Bitcoin will use that as an argument against the crypto, saying if the Fed is planning to roll out a digital dollar, if, like I said, the euro, China, other central banks, that this will go against Bitcoin. Why they'll do anything in their power to bring down Bitcoin. So what's your answer to that?
I don't see that in reality. What I see is a bunch of governments that want to get the tax collection off the growth of this industry. If they were going to take it down, the time to take it down was when it was a lot smaller and a lot less significant. Now there's a ginormous leap of money for them to collect upon. And as the market cap gets bigger and bigger and bigger, there's a bigger honeypot for the governments to try and collect. So I don't really see the same things that people are fearing. In terms of Fed coin being a competitor to Bitcoin or something that it wants to take down, really Fed coin is a mechanism for getting money into exchanges. And remember, we already have digital currency. It's just who creates it that's changing. At the moment, the digital currency, the Fed coin, is created by private banks and is backed by debt every time they issue a loan. There's no radical shift here in terms of what's actually happening, because almost 97% of dollars are already digital. What they are doing, which is radical, is changing who creates it and who benefits from its creation. And so when the Fed decides to actually create the money supply rather than allowing the commercial banks to do it, and then try and control how much money the commercial banks create, it doesn't change the fundamentals of, it's just who creates it and who benefits from it. So I don't see much of a shift in terms of behavior with Bitcoin. What I do see is that it actually it makes the need for Bitcoin more easy to understand, because when you implement the complete censorship with your Fed coin, when you implement the complete control with Fed coin at the central bank rather than having a bank in the middle, and when they print it excessively and based upon artificial intelligence and fiscal and monetary goals, not just monetary policy, less independent, then I think that it really drives the need for owning your own money, spending your own money, and having a money policy that can't really change. So I don't see those same things that are acting out in reality. I know there's a lot of central bankers that are very hostile towards it. But those are the countries which are going to, the ones that are the most hostile are the ones that are going to have the most challenges when other countries in upcoming currency wars put some of those Bitcoin on their balance sheet, and they see the difference in effect when people are holding dollars on their balance sheet versus Bitcoin on their balance sheet.
Simon, I want to talk price now. I understand long-term is really your focus and you don't get bogged down by the day-to-day movements. But here we're close to a key technical level, and there's concern that should we reach 30,000, there could be a major technical sell-off. How do you see that?
Yeah, I mean, I don't do short-term price too much, but I'd expect to see a correction. I hope for a correction to approximately 20 to 25,000, so that all those people, when it was up at 65,000, said if it crashed to 20,000, I'd do anything to get in. But the reality is that those people won't get in because they'll be fearful that it's failing. But the lower the price goes, the better for the long-term accumulator. the better for those that didn't get the opportunity to get in at the highs when everybody else is buying. And that's exactly what we're seeing when you analyze the on-chain. You see that those that own more than 1,000 Bitcoin are sucking up all of these Bitcoins from people that own less than 1,000 Bitcoin. So this is just a redistribution to the ultra wealthy that's happening at the expense of people that are being fearful and looking at the short-term prices. So, this is, I would expect it to come back to 20,000. And if you're thinking of the long term, then the lower the price goes, if you're dollar cost averaging and you're accumulating every month, then the opportunity, if you're thinking in terms of the number of Bitcoin, the lower the price goes, the better for you. If you're thinking in terms of fiat, then you're just thinking about what the price is so that you can try and get out some of that fiat. And really, the ones that have done well have had a real shift in their thinking. They've unwound some Bitcoin to spend as they need to, but their goal is to accumulate as much Bitcoin, not as much fiat.
If we were to go back down to 20,000, Simon, we've had people on the show. Max Kaiser probably had the most famous forecast for the year, the 220,000 by end of year. If we go to 20,000, and I'm not saying 220,000 was your forecast, but could that even happen?
It can happen. So you got to remember, short term, the market is very manipulated by very wealthy Bitcoiners that want to accumulate as much Bitcoin as they can, and they can short term control the flow, putting it into exchanges, spooking people, and use all of the announcements to try and scare people. If it crashes to 20,000, I did, when I was on my YouTube channel at Simon Dixon, I did tell people, get ready for the great Bitcoin crash. That was around April. I said that because I've seen this so many times before. Now, can you go from 20,000 to 200,000? We've seen those movements before, and it can happen in very quick periods of time. So, and it's taking a scope out, looking at the long term, seeing a 12-year bull market, and seeing that we've seen movements like that, crashes at that level of severity and bounces back. So you can expect all those things to still happen.
Let's just wrap on a lighter note. I follow you on Twitter, Simon. I invite everyone to follow you on Twitter. You have a great account. And I liked one video you recently did, close to my heart, regarding the Euro that just wrapped now, the soccer, the tournament. Sad for you that your England lost. Happy for me that my Italia won. But you said there's a lesson here to be learned that Bitcoin investors can learn from.
Yeah, so I gave a video on Twitter. There's I actually can't even remember the exact lessons that I gave. They're quite off
you
the cuff.
You were too upset over the loss.
Yeah, too upset over the loss. But it was about being happy for the other team. Italy has had a very challenging time, and if you can retrain your brain to be happy for the others, there's so much that happens in the crypto markets. It's a very people are always often looking at their winning team. And so I gave some lessons in there, but it was very much off the fly, off the cuff. When I speak on Twitter, there's no preparation. I'm just talking about what's on my mind at that time. So maybe I'll re-review that video and try and remember exactly what I said.
Well, then I urge everyone to try and find it, because I thought it was a great one. Simon, thank you so much. Thank you for kicking off the summer series here with me on StansberryInvestor.com.
Okay, always a pleasure. Look forward to the winter series then.
Really great thoughts. Come back soon. And thank you all for watching. We'll have much more for you on StansberryInvestor.com. We're just kicking off our summer series, and we have a lot of incredible guests coming up. And don't forget to check out messagefromeric.com, because on July 21st, Eric Wade will be discussing the most important disruption in the history of the crypto world, where Eric will show you how to opt out of the traditional financial world and generate income like nowhere else in the world today. It's not buy Bitcoin or buy Ethereum or any other single opportunity in the crypto world. It's much bigger. So make sure to opt in today for this totally free event. That's it for me. Thanks for watching. I'm Daniela Cambone.